I want to talk about 3 financial moves that get a little harder once you retire. Most people spend years building up their financial picture before they retire. So they're working on saving money, reducing debt, building up their assets, and then they retire feeling like they're on solid footing, financially speaking. What surprises a lot of people is that certain financial doors get a little harder to open once you stop working. Not because anything went wrong, it's just because how the system actually works. Here's the underlying reason. Lenders and financial institutions, banks, look at your income differently than they're looking at your assets, your financial picture. So a steady paycheck, even a modest one, carries enormous weight when they're evaluating you for certain financial tools. Once that paycheck stops, the math really changes. And even when your net worth hasn't budged an inch, your assets haven't really changed, your income picture has changed. So here are 3 specific situations that sometimes catch people off guard. So the first point is lines of credit. The window closes pretty quietly. A home equity line of credit or a home equity loan can be a pretty good tool in retirement, not because you want to start carrying debt all over again, but because having access to instant liquidity gives you options, and that's pretty important. So things like home repairs, things that come up kind of suddenly, maybe a bridge between accounts, an unexpected expense. Life doesn't stop being expensive just because you stopped working. Here's the catch. Banks and financial companies will approve home equity lines of credit based largely on your income. So the same household that easily qualifies at 59 or 60 because you're bringing in a solid paycheck may have a different financial picture at 65 when the paychecks stop rolling in, even with the same amount of home equity, even with the same kind of savings and investments. If a home equity line of credit or a home equity loan is something that might make sense for you in the first few years of retirement, setting it up before your income stops, it's worth putting on your checklist. Okay, second point, mortgage and housing decisions. Employed borrowers sometimes see better terms on their loans. A surprising number of people reach retirement with a move somewhere on the horizon. Once we stop working, we're going to sell the house and downsize, or we're going to relocate closer to family, or we're going to relocate away from family, or we're just going to go to a different community. What they don't always anticipate is that financing that move as a retiree might be a different looking picture than what it was like when you had a steady paycheck coming in. Mortgage lenders want to see consistent income. Yes, retirement distributions and withdrawals from your investments can qualify, but it typically requires more documentation. There's going to be more scrutiny, and sometimes it's going to result in less favorable terms. It's worth knowing before you dive in head first. Okay, point 3, and this catches people off guard a lot of times. It's about your credit score and maintaining that good credit score that you have as you went into retirement. Most retirees in general use credit less than they did when they were working, and that's a good thing. So there's fewer big purchases, there's less borrowing in general, there's more living on assets, living on savings. That's terrific. That's what we want to see. But credit scores don't reward inactivity. They reward consistent, responsible use. So in general, retirees are going to have fewer open lines of credit, fewer open accounts, lower activity in these accounts, and reduced credit inquiries. These kind of things can cause your credit score to drift lower over time. It's not because you did anything wrong. You actually did everything right, but it's simply because the credit bureaus have less recent data to work with. So to some degree, it's use it or lose it when it comes to your credit score. A softening credit score, it matters because it goes right back to the things we just talked about. The home equity line of credit or the home equity loan that you meant to set up while you were working, or the mortgage refinance that you were considering. Access to those tools depends in part on where your credit score stands when you need them. So none of this is meant to make retirement feel complicated, because it isn't. But just know that there's a window of time where a few smart conversations can make a real difference in what your options look like on the other side as you're retiring. At Malooly Asset Management, this is exactly the kinds of topics we're talking about with our clients here in Central New Jersey. If you're getting close, or if you're at the finish line going into that transition to retirement and want to walk through what your picture looks like, use the link in the description below. It'll be a good place to start.